In assessing and selecting investment managers at Infinity, we place great emphasis on the investment process and how the investment manager applies it over time to help determine performance. How does Jamieson Coote Bonds apply its process, and how has it performed over time?
Well, the process that we utilise has been honed over long careers, as I said, built up from offshore experiences. Primarily, the process involves monitoring macroeconomic development and data velocity, both monetary and political politics, and then the flow and supply of those instruments throughout the system. The performance of which, when it's all combined, has generated material outperformance for our investors over and above an indexed product which has generated very strong performance despite all of the negative headlines you might hear about bond markets. So there is a chart that you can see in the video presentation where not only as a standalone product the bond market and the high grade market has vastly outperformed term deposits at a time when globally interest rates have been rising, but coupled with our outperformance above that complex, we've managed to generate returns around about the 4% mark, which we're very pleased about. I guess the product is there to defend and protect in periods of great uncertainty and instability. We haven't really had them in the portfolio since the portfolio's been in operation, but maybe its most important work lies ahead. If we can throw up these types of returns on that process in this more benign environment, then we think this has got a really critical role to play for investors should things get more challenged looking forward.
And Charlie, why would someone consider investing in the Australian active government bond strategy today?
Yeah, look, as we touched on just in terms of the outperformance, it's also important to make sure that investors have the right product for purpose. And certainly as we are moving into this later cycle environment, where liquidity is starting to be withdrawn, both domestically via the Royal Commission and globally via higher interest rates, it's very important that portfolios have this very pure defend and protect type allocation so that investors have great optionality around what they want to do with their portfolios if markets are to reprice. It's also important that they give great thought around credit quality, and so certainly in a government-only product with the government standing behind these instruments, there's very little to worry about in that regard. So there is a lot of portfolio benefit that we can see in a product such as this, but particularly at this late cycle when often more growth-styled assets can decline in pricing. This is something that should be performing, and it does allow investors to have great flexibility as they look to renegotiate and reallocate into that changing complex.
And finally, Charlie, given that we're in that late cycle environment that you mentioned, what's your macroeconomic view for what's ahead in the short term and beyond? And what's your outlook on interest rates, risk, and what does it all mean for Australian investors?
Yeah, clearly it looks like there's some challenges coming down the road, I guess, as a result of the Royal Commission, both in Australia and then higher interest rates in offshore markets. We're already seeing periods of quite severe volatility in many markets. And certainly with higher funding costs looking forward and less credit availability, we're already seeing the housing markets starting to roll over a little bit, particularly on the east coast of Australia. It is a point at which, in that late cycle environment, investors have had a really good run with their growth assets, and it's probably time to look at some of these more defensive alternatives to ride out the shifting structures and the change in the wind, which seems to be upon us at the moment.
Thanks very much, Charlie.
Thank you, Andrew.